Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to continue to talk about strategies. Strategies to make money, strategies of what I look for in some of the technical charts. What are some things that I look at for a confluence of information to better strengthen the probability of success? In the markets, we can't say that we have a 100% probability of success, unfortunately. What we do is we look for, again, the three pillars. We look for the tailwinds in the market conditions. We look for a cheap ratio with a long valuation ahead of us. And then we look for technical analysis, which is an unbiased opinion from the markets showing us that money is rotating and moving into our sectors. And that's about all that you can do. You're going to have a time frame that is long enough for it to work. And again, I am using my time frame and those valuations and the market conditions. That is how I'm hedging myself. I'm hedging myself with time. So if I know for a fact that something's cheap, and I know that the market conditions are ripe for this asset to appreciate, I have to use time as my hedge. So I'm hedging myself with a longer time frame. Short-term time frames are very difficult to make money in because you're not using valuation, you're not using fundamentals. What you're basing everything off of on a very short time frame is 100% off of news and off of the emotions and the whims of people. And you can use those emotions and whims to your advantage. The way that you would want to do that is if the market is very fearful in the market and they drive stocks really low, you can buy very cheap assets for even cheaper. So when you look at the markets, you're not going to be able to necessarily predict those fearful events. One event that is a fearful event is Global Atomic in Niger. That is an event where Global Atomic got sold off dramatically. Now, we don't know the certainty of that outcome. We don't know if it's going to be positive, negative. We don't know necessarily how Global Atomic will be necessarily impacted. I am in the camp, and obviously it's easily debatable that I would buy more at that bottom portion because there was that much fear in the market. And I think Global Atomic is one of the better uranium companies in terms of its prospects. And I would take the risk. And that's what I did. I took the risk and I bought it at the bottom. I cost averaged 2 times in. I bought one early, smaller position, and then I bought a bigger one as I thought it was for surely at a bottom. But that's me. That's what I did. It's fear in the market. People sold it off, and that's what I did in that. We also have other things that I looked at. We've got an alignment in uranium, and we can go over some of these alignments, and I'll show you what I mean by that. So let's dive in. I'm going to kind of jump around. This isn't scripted by any means. I'm just talking off the top of my head, and we're going over a bunch of data and what I look for. So looking at this, we've got URNM versus the futures pricing. So UX1 is the futures pricing. So if I were to pull up this, I'll just pull it up to show you guys. This is the futures pricing. And if you look at the futures pricing, I mean, guys, this looks ridiculous. Ridiculously awesome. What you want to see just from a big picture view, you want to see a downtrend. You want to see a bottoming pattern. And then you are going to go into an uptrend. That is what every kind of commodity person's dream is you want to see this type of trading. A lot of the times you'll see almost like a bowl-shaped formation come. And in order to make obscene amounts of money, we're talking obscene amounts of money, you got to get in when this is basically bottomed and it starts to come on up. You can see that these lows are starting to come on up. So somewhere in this range, you want to load up in some of these equities if you're playing the equity game If you're playing the commodity straight up, you're going to want to buy it when it's down here. Basically, you've got slowing momentum. Your momentum, if you were to look at this momentum, you've got strong velocity, less velocity, and then this velocity is turned on up. So you want to buy it in that circle where I've got it. And then you're going to start to see the velocity start to kick up to the upside. And in order to identify a lot of this, what you can do is you can price this commodity against gold. And gold is our measuring stick. Gold is the inflation adjusted measuring stick. So if I were to price a gold to uranium ratio, so let me see. Actually, let's do uranium to gold ratio because it might look a little bit different. And I think it'll be easier for you guys to get it. So this is the uranium to gold ratio. It's going to be amplified to some degree, I think, but you can see downward motion, sideways motion, and we're just about to break up to the upside here with the uranium to gold ratio here. We can see we're moving up, and if we break kind of this guy at 0.05, a little bit above it, we're going to get a lot more momentum. So this is telling us, if you were to look at this ratio compared to history, that down here is undeniably cheap. Here's the negative factor of it, right? Well, it was also cheap down here. And you could have went into 2011, 2012 and say, okay, I should be buying uranium at this point over here. But that's where you have to tie in that alignment of all the market conditions. You have to say, well, when does uranium go up? And the market conditions where uranium goes up is in a expansionary phase of real estate. So this was not over here an expansion phase of real estate. Now, you could argue that over here in 2018, 2019, that was starting to get into an expansionary phase of real estate. That is where credit expands in the system and puts commodities into a shortage. It's the credit growth in relationship to the supply. So we should be seeing this start to turn up under that credit expansion. And it is. It is. So what we have here is a pretty good alignment. We've got uranium that's cheap to gold, and you could price uranium against other assets. It's basically cheap to everything. And if you guys want to see that, I'll show you it. This is uranium to silver, cheap and about to break to the upside. Uranium to the S&P 500, momentum, cheap, breaking, and we're right at the ideal buy point, basically, where uranium's breaking out against the S&P 500. This is an absolute gift of a setup right now. For everyone. Then you can look at uranium to gold, which we were just doing, uranium to crude oil, and this is going to hold itself, I think, in a pretty tight pattern here. But uranium could outperform crude even. Uranium versus copper. We back out. This thing's ready to break, move to the upside. So that's uranium with an outperformance potentially. This is uranium versus nat gas. Now, nat gas is cheap as all get out. Nat gas is an anomaly. So nat gas would also be another one to look at. Uranium versus Dow Jones, you can see that we're just breaking out here, and we're going to see probably a large outperformance of uranium versus stocks. And then you've got uranium versus, this is palladium. And I've got palladium. Now, why did I use palladium? Palladium generally works well in the other market condition. So when you go into the other market condition, which is a recovery phase of real estate, so uranium is going to fall like a rock in a recession. Then it's going to basically underperform palladium to a certain extent. And now the market condition has changed. We can undeniably say that from this point on that it's changed. That's what we need. We need the confluence of all of these, all this data to tell us that an asset is about to outperform everything. And uranium is about to outperform everything, as far as I can tell. From all these different charts. Now, that is kind of some of the background that I look at. That is uranium is low. So we want the momentum coming down. So let's look at this real quick just from the uranium perspective here. We want the momentum to work its way off, and then we want to start coming back up. And what does that mean by coming back up? We want to see the lows. If we were to draw lows in here, we want the lows to continue to work its way on up. See those lows as it comes on up? That means that we're gaining momentum. is what we're doing. And it's going to strengthen to the upside, and we're going to get a blow off top at some point in the future. And uranium's about to outperform every other asset, and that's why I was looking at uranium versus all the other assets. So when I look at that, it looks like uranium's about to outperform everything. Now, this doesn't mean that it will do it tomorrow. It could, but it means that over a long period of time, let's say the next 2, 3, 4, 5 years, we could see a vast outperformance of uranium versus all the other assets. That gets me interested. Relative performance means that I can buy more of those other assets. I am increasing my purchasing power. Now, when we get into these levels where uranium's about to outperform, we can start looking at the ETFs and stocks. URNM versus UX1. So what this is we're pricing the ETF URNM versus the commodity itself. And what are we going to see? Well, we're going to see that we are breaking the downtrend line here recently, where the equities are about to outperform the uranium physical price itself. So now we want to stack this evidence, where we're stacking evidence here. So we saw that uranium, the futures pricing, was basically going to outperform all the other commodities. Now we're starting to see the equities start to break out against uranium's future pricing. So if uranium's going to outperform all the other commodities and the equities are going to outperform the uranium futures price, well, that's a strong confluence of evidence that we are probably going to have a strong outperformance of the equities, and that we're in a uranium bull market. Another thing that we can look at is we can say, okay, uranium is an energy stock, so we should probably look to see how crude oil is doing. So then you go and you look at crude oil, and you look at the big picture view of crude oil. What you see here is you see a breakout, and I drew this on logarithmic. I don't have it on logarithmic now, because if I do it on log, I'll do it on log. All right, it's going to do that, and then I have to zoom in on it again because of the negative pricing that we got in the markets there. So here's the movement in crude oil. The last bull market in crude oil is back here. It was wave 1, wave 2, wave 3, wave 4, wave 5, and then we went into this big consolidation zone with a blowout bottom. Perfect time where that circle is to buy the crap out of it. We've come up on wave 1, we've come back on wave 2, and we've broken, and I think we've probably entered wave 3, where we're going to get a big move in crude oil. So that's more confluence of evidence that, crude oil is not going into this gigantic, decline. It's actually strengthening. It's more confluence of evidence that if the energy sector is good, that it could probably also be tailwinds for the uranium sector. So you start adding up all this data when you look at this. Then you can start pricing things where we look at like URA divided by UX1. I'm using URA because it has more data behind it. And here's URA versus UX1. And you can see that we've got the downward motion movement. We've got kind of the double bottom pattern here. And we did come all the way back in terms of this ratio where uranium is just ultra cheap. And we're breaking that downtrend line in this ratio. Let me zoom in here. And you can see that we're breaking that downtrend line in the ratio there. Let me auto fit this. There we go. So we're breaking that downtrend line in the ratio there, and I drew that on the longer term, but we're breaking that downtrend line. Well, what does this mean? Well, one, it says that the ratio is telling us that URA is incredibly cheap in relationship to the uranium futures pricing. That is all you could buy in history that's cheaper than where we are today. The bottom of 2020, the beginning of 2016, and we're at that same ratio again. So we are at a very prime spot for the ratio to dramatically outperform the future pricing itself. What it's telling us is that the uranium equities are incredibly cheap. Now, if uranium is going to break to the upside, and if we've broken the downtrend line for URA, this is probably one of the best opportunities in the market that it's going to offer you in terms of where a good location is for a buy point, in terms of valuations, the ratios that I'm going over. The market conditions are right for this to go higher. We have the uranium futures pricing already taking traction and moving on up. So it's all right there, guys. That's the confluence of all the data. In order to make obscene amounts of money, you need to buy this when it's low. And then you want this to appreciate against the uranium futures price or the commodity price when the commodity is going up. That is where you make a bunch of money. Now, on Twitter, I've heard some people say, um, you know, some companies, they only have 200-300% max to go up. I completely and utterly disagree with that. Completely. If you are at a ratio that's at this particular area, what this is telling us, and if we want to just do a quick some math here for the heck of it, and we can do that together here. I'll bring up the calculator for you guys. So if this is the peak, and our peak was at 2 in 2011, and that's just at 2011. Let's say it's 2. If we go from 0.4 to 2, what that means is you go 2 divided by 0.4. That means that the uranium equities, URA, that's URA, is going to outperform the futures pricing by 5 times if this ratio were to come back to 2. So if uranium goes up 3 times, that means that URA would go up 15 times if it were to go back to this ratio of 2. So if someone were to say, oh, it's only got a 2-3x, that's all we've got left, I would say, you're smoking crack. I think that you've got 2 or 3x in the uranium price, easily. Then you have to say, okay, what's the outperformance that URA is going to do? If you go to the back to the top of 2011's high, that's a 5x of the 2-3x or greater of the actual physical uranium price, if that were to occur. That's more like a 15x, 20x, something like that. I think is still possible. Now, if you get some of these small uranium companies, and I'll show you one, guys. I know you guys are thirsty for these. Bannerman is one of my favorite companies. So I'm going to do Bannerman divided by. Actually, I'm going to do the Aussie price. So I'm going to choose Bannerman here, and then I'm going to choose and divide it by UX1, which is the uranium futures pricing. Oh gosh, hold on, guys, hold on. MN ASX. There we go. All right, so this is the Bannerman versus the UX1 price. We can also do technical analysis on this as well. And what you have here is you basically have a bottoming. We have the momentum coming down. We went into a bottoming formation here. We've broken out of that bottoming formation and we did a retest. This circle here, if I were to pull up like an ideal buy point, an ideal buy point is when you basically buy the breakout where this first circle is, and then you buy the back test here. That's the ideal buy point. Now, Bannerman is a higher cost producer. A lot of people think, oh, it's a high cost producer, it's not going to go up. No, guys, completely opposite. The high cost producers in a gigantic uranium bull market could potentially have the greatest amount of return. In my opinion, Bannerman could be one of the candidates of a handful that could be one of the largest returning companies. We're also at a very ideal buy point with the ratio. So we've already done basically the double bottom. We've broken out, and this is the ideal buy point right here. I bought the buy point down here. I bought the buy point on multiple times. I bought Bannerman on all these different occasions. It's kind of my cost average would be somewhere like in here or something. So this here, if it were to go up, you can see that we would go up to a level of 0.45, 0.45, and that's the 2007 peak. So if I were to use that peak, if we were to go back to that peak, and that's at 0.44, And again, there's no guarantee that we're going back to that peak. I'm just using it for a simple calculation. 0.44, and we are currently at a ratio of 0.035. That means that Bannerman's going to outperform uranium by 12.5 times. 12.5 times. So if uranium goes up, I'm going to throw out a number, okay, guys? If uranium goes from 60 to 180, which is 3 times, it could be a 37 bagger from where we are today, using the logic that we are going to replicate the same ratio of where it was before to where it's going to be today. Now, Bannerman did not have the same assets as what it did last cycle. We have way more assets and proven reserves, and we've got they've got all their stuff ready for a potential developer to go into production at some point. They're right at that last gate with their feasibility studies. There's a ton more value in Bannerman than there was back then. So you could argue that that valuation metric is low. You could argue that money flows won't favor Bannerman as favorably as before. You could also do that, and you could say that ratio is too high. Either way, I'm going to take some speculative money, because this is not a cash flow producing company, and speculate that this is going to basically go up and return back to those levels. The way that I'm viewing this market is it's the same approach across any of the other commodities. It's the same approach that I use with looking at some of the individual companies. And this is where I build a portfolio around. It's based off of great technical analysis and the patterns that are exhibited by these companies. It's companies that exhibit lopsided asymmetric bets. The lopsidedness will save my bacon. So what does that mean? If one of these companies, if they get wiped out, wipe it out of the portfolio, my position size is the risk. The upside potential, because it's so lopsided in symmetry. So if this gets upside of 20, 30x, and I lose one position, which is only 100% of my money, I'll make it up on another position. And if I've got a couple of these, let's say there's 10 companies that possess all these traits, and I invest across all 10 companies with a certain amount of money, not my entire portfolio, guys. I size it properly, and I get an average of 10 or 20x on some of these of the smaller guys, and I have a decent position that I think is decent for it, a few percent maybe of the portfolio in each position. I'm going to win big, and it's based off of kind of statistical probability. So a lot of my positions, not all of them, but a lot, almost all of them, are derived from this approach. Some of them are just completely based off the ratio, like physical metals and stuff like that. You don't really have all these other different ratios. So what you're doing here is you're playing a multi-ratio bet. And I'm gonna give you another multi-ratio bet real quick, and I'll just use natural gas. So what I'm gonna do is I'm gonna go to the ratios again and show you what a multi-ratio bet is. If I can find it. Okay, here we go. So I'm going to take crude oil, and here's crude oil versus Dow Jones Industrial Average. Okay, I'm going to get off logarithmic. So what we have here is basically a bottoming pattern. You can see we fell throughout history. We went sideways. We've got this double bottom. We had a little mini commodity boom from 1998, 99, all the way to the peak of 2008, where we hit resistance again. Then we came back down. We put in this fake bottom, and then I think we're going to come all the way back up and then come all the way back, maybe even to the peak here. Why do I think we're going to outperform this bull market in commodities? Because this bull market in commodities was in a declining interest rate environment. I think the bull market over on the right-hand side is going to be in an increasing interest rate environment, which is going to rotate more money into commodities than the other stocks and bonds. More money is going to rotate out and seek safety in commodities and in precious metals. Obviously, my opinion could easily be debated. I understand that. So we've got this big move that could happen in crude oil. it's incredibly cheap in relationship to the Dow Jones Industrial Average. So one could make the conclusion that crude oil is in fact cheap against the Dow Jones. Now, when we look at crude oil versus nat gas, we can look at this, and there were times in history where nat gas really was more expensive versus crude oil, much like the 2000s all the way to about 2008. Then we went into a period that was even cheaper. We are at a very cheap ratio with nat gas in relationship to crude oil. So if nat gas is up here at a very cheap ratio against crude oil, and crude oil is cheap against the Dow Jones and stocks, we could say that nat gas is absolutely ridiculously priced against. So here against, okay, let me go nat gas against Dow Jones. So here's, let me go nat gas against Dow Jones. So here's nat gas against Dow Jones Industrial Average. So when you evaluate this, you can see that there's a downward motion, downward move in nat gas to Dow Jones, favorable for Dow Jones, favorable for nat gas, favorable for Dow Jones, favorable for nat gas that we're going into. That's the big picture trend that I see using this ratio. And this is also in full alignment with all these other ratios that I look at. This is just a lot of the data that I look at and seek. And I know I don't go over this stuff every single video or every single second. I know there's some new subscribers that may be confused. They're going, why? How is this guy? How does he know this? And what I found out is that the reason that these things are moving against each other is based off of the credit expansion cycles in real estate. That is what it's tied to. So what's coming ahead of us? A gigantic commodity bull market. Nat gas, uranium, a lot of these energy companies are most likely going to vastly outperform. And you can even look at like a crude oil versus gold ratio. And if you were to do, this is crude oil versus gold, you can see an outperformance during these years, an underperformance, and then you can see that we just broke that downtrend line and that we're probably going to head on higher. We just had our first return move there, which is a great ideal buy point in a lot of the crude oil, nat gas equities. Just right down here, perfect buy point. I know a lot of people, they're going to be screaming recession. They're going to be screaming all these different things. What I try to do is objectively look at all these things. And this is how you objectively do it. News isn't going to tell you anything. This is how money is positioning in the assets. So if I were to go back and look at this, money is positioning in crude oil for an outperformance of crude oil against gold. And that's how it's being positioned at this time, at least. So that is what we're seeing in the markets. And some people, they don't believe this stuff, which is fine. You don't have to believe it. If you don't want to use this type of analysis, okay. I believe in it. I think it's the most objective. It's the most objective way to view the markets. And if you know what assets outperform during certain market conditions, you can basically objectively tell the market conditions without looking at any piece of news or gaining any other information necessarily on anything else. You could just go by these charts and say, yep, this is outperforming. Yep, this is what condition we're in. I don't even need to know basically anything. You could tell all through comparing certain ratios against each other. And basically what you do is you could say this was an inflationary period. This is how the assets performed. This is another inflationary period. This is how the assets performed. So if every time crude oil got expensive to gold was during an inflationary period or a little bit more inflationary period, then you could conclude that whenever crude oil goes expensive against gold, that you're in an inflationary period. And if it ekes out, at almost 100%, thing, well, then that's what you could use to make conclusions using basically just objective evidence. So that's what we've got. I know we've got one of the picks there, Bannerman. You should be watching that thing. It's ready to go. Um, that's looking real good. And again, I've got a whole bunch of other picks. There's other ones that we look for, and the strategy here is to buy when things are down. I'm not chasing price. I'm chasing patterns. I'm chasing value, and I'm changing and hoping that that market condition, the tailwinds that are behind the transfer of money, the rotation of money into these assets continues. And we're going to stay, well, at least I'm going to stay long in these assets as long as the market conditions tell me I should be long and as long as the valuations are reasonable. And I'm going to try to ride it all the way to the top. The only time I would switch into a different asset is if I thought I found a better opportunity. The opportunity could be more upside. The opportunity could be better risk reward, or a combination of multiple things. It could be very good risk reward with gigantic upside. I might want to pile into that. So that's how I'm doing it. It's a little bit more of the strategy that I'm deploying. I can teach you this stuff. I can help you guys with this commodity bull market that's coming. If you want to join the website, up to you. We do have a 50% discount called September if you want to join on the monthly membership. And that's what I have to offer there. This is what I'm doing. My track record, I don't want to divulge all of the companies, but I can divulge another one. We were very heavy into energy service companies. Helix Energy Solutions is one that we had entered. It had a very good pattern. Basically, it's got the three hump consolidation. We bought it in this corner over here in the tip, and we've been riding it up. I think a lot of the members have been in at like the $3, $3.50 range is probably where the majority got in. Another one that we got into was Diamond Offshore Drilling. This is another one that we got in down in this corner over here. We cost averaged in over there, and we've been riding it on the way up. And it's basically a doubling. We have a lot of other ones too. Not all of them are going to be 100% successful. We have some that we're going to have to wait on. We were buying uranium, and uranium's just starting to get heated up. So we've had to wait on that. Some of the smaller positions are down, and they've been down. Some of them could be down 40%. Cost average in, continue to accumulate those, and the time of the sun, I think, is coming for uranium here at any time. So just to give you some examples of some of the companies that we look at, I am still very much in the energy service realm. There's also fertilizers that look pretty good. Uranium companies, we're always looking at those. A lot of big dividend paying companies as well, if you want to get into the dividend portion of it with commodities. And I'm in that section too. I play a little bit of all these companies. So that's what we've got. That's what I've got going on right now. We're going to end it there. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.